Hey guys, what's going on? It's a highly important video if you are a day trader or a swing trader. The most important subject of this video is going to be breaking down the strike prices, strike price calculation, because honestly, a good strike price could either take your account to the moon or it could break you and knock you the hell out. Now, understand this, before you attempt any of these trades, you should take all of our trading courses here at 13marketmoves.com. But for those of you that are trying to follow the channel, that for whatever reason still have not pulled the trigger, you're probably getting knocked out of some crazy, exceptional trades that are generating 5x, 10x. And for that reason, in this video, I'm going to break down three trades, specifically analyzing the strike prices and understanding the strike prices of what differentiates a trader that makes a couple of $100 or maybe a couple $1,000 in a trade, opposed to the trader that generates $10,000, $20,000 on the same type of trade. Yes, damn it, you heard me right. The same trade. One trader makes $1,000, another trader makes $20,000. What is the damn difference? If you're interested in knowing that, watch the video till the very end. Now, let's address this aspect right out of the gateway, and that is, if you're trading stocks, great. It's easy. Trading stocks is easy. Trading penny stocks is a little bit more difficult. But if you aspire to the greatest challenge of all times in the stock market, that is trading options. And if you want to go even above that level, times 100, that is trading weekly options. So this is a video for those of you that aspire to be the rock stars of trading. For those of you that cannot stand making 10, 20, 30% on a trade, this video is for those of you that would actually puke. Seriously, you would fucking puke if you had to collect a 10% dividend. But instead, you strive to conquer the world like Alexander the Great. For those of you that are the Alexander the Great type, you're going to learn a lot from this video. So without any further ado, don't get knocked out by the market, okay? And the only way to do that is to understand the market move. So we're going to analyze three trades right now that we have taken with our students on April the 30th, 2021. And the purpose of analyzing this trade is to help you understand what makes a good strike, what makes a bad strike, and how you can improve before next week, before we trade the earnings season again next week. Next week, guys, oh my God, there's so many unbelievable trades next week. I want to make sure you understand this material before you trade next week. So here it is. The first trade we've taken on Friday was FSLR. You may think, whoa, I mean, FSLR, what's going on with that? The last video you've posted, Leonardo, was all about the crazy Amazon puts and Google puts while they were reporting these great earnings. Yes, but it's important to acknowledge, and if you would have had the win and watch list, you would have known that it especially matters to trade pop to drop, which is what all of these trades are based on. They're based on a 90% probability type pattern that gives you an insane probability of nailing these trades in your favor. And it's just a matter of understanding the market moves, whether you're going to make 1,000 or 20,000, which is exactly what we're going to dive into here shortly. But first, what does FSLR have to do with a stock like Amazon or Google or Facebook? Well, it ain't got nothing to do with any of these stocks. However, what they have in similarity right now is the pattern. And that is the pattern. Watch this right here. This is the earnings report, 1.96 per share. What does the stock do? It pops. It pops to what? To 90, 91 level right here, which is an incredibly well-defined level of resistance, which the stock hasn't been able, honestly, to get any sort of traction above that level in the last few months. So it's important to pay attention to that level. But on the other side, when it comes to determining your strike price, what would you do? What would you do really determines the outcome of your trade. So focus on this pattern. It's a pop and a drop. I mean, clearly you can see a pop from 87 to 90, 91 area after the company reports earnings, and then it drops like a rock. So, well, Leonardo, how can you be so certain? How can you, like, let me show you how this shit works right here, guys. It don't have to be a rocket science. The point is, it doesn't matter what your prior experience in life is, whatever you've been doing. If you understand this information right here, you're going to improve on selecting your strike prices. So bottom line is this. The stock opens the next morning after the earnings report at a level of about $85, 84.93, as you can see right here. That's the market open, okay? And what happens next? The stock drops, it pops. Actually, let me take you, this is a 5-day chart to help you visualize this 90-91 level, but let me take you to a 2-day, 2-minute chart so you can visualize it a little bit better, because in this video I'm going to show you 3 trades based off the difficulty level, and this is honestly the easiest trade. Let me explain you why this is the easiest trade. So it opens at this level of just under 85 bucks, and then it drops. And it pops. And honestly, if you're a day trader, you're like, oh my God, I just bought some puts. And, you know, depending on what kind of fill you got, you're like, oh shit. Oh shit, I see some green candles right here. Let me get the fuck out. And this is how an average trader collects maybe 500, 1,000 bucks, but they miss out on an opportunity to make $20,000 that day. Why? I'll tell you fucking why. It's very simple. It's because they don't understand the market moves. It's either they got a bootleg course, a 13 market move somewhere, or they got the real course. They didn't study it well enough. They still don't understand the difference between a 3 and a fucking 11, okay? And that's why you got traders jumping out of a simple situation like this. In a move 3, what do you want to do? You want to short every bounce. We've told you in the last video posted here on our channel. You want to short the bounce. The pattern is there. You want to simply execute on the highest probability pattern, which is shorting the bounce. And for those of you that have a hard time understanding what shorting the bounce is, let me play this quick video clip to help you refresh your memory. And now that we're back, hopefully you understand. Shorting bounce, this is your entry, not your exit. However, the most common mistake that people make, what do? The stock drops. They're like, oh my God, they're buying puts here. They're not buying here. Why are they not buying puts here? Because they're still not sure. But hold on, the stock was just at 90. I should buy the fucking dip. But the time they make up their fucking mind, okay, the market knocks them the fuck out. So if you buy calls right here, oh, the market is so bullish, oh, everything is so fucking great. You buy calls, you get killed. You got knocked the fuck out right here if you buy calls right here, guys. Because the next few moments, you're like, I shouldn't have bought the damn dip. It was too early to buy the dip. But, you know, all of you guys live in shitty comments on this channel. You just don't understand what it means to short the bounce. So I'm recording this video to make sure that you do not miss the next opportunity where you can take $1,000 into 20,000 bucks. So bottom line, here's the deal. Instead of buying calls right here, what you want to do is you want to buy puts. And when the market pops or rebounds or bounces, what you want to do is not exit the trade, but you want to buy what? Hell right, you want to buy puts. The market drops, you want to collect gains. It bounces, you want to, what do you want to do? You want to buy puts. This is not the area when you want to buy calls. It drops. What do you want to do? You want to cash out of your fucking trade. You want to wait for a bounce. You want to buy puts ultimately to cash out. Now, with 13 market moves, honestly, you wouldn't have to go for all this difficulty if you're a scalper. As a matter of fact, if you're a scalper, I can guess the size of your fucking account within $100 bucks. Because you ain't making no fucking money in the market. And that's just the fucking truth from somebody that's been trading the markets for close to 15, 16 years. I can tell you with 100% certainty, you ain't putting no fucking 5x, 10x trades. And if you're not doing that, your account is going nowhere. So get a pen and a piece of paper and write down what makes the difference for somebody that does and somebody that barely survives this market, or for worse, you will get knocked the hell out if you're trying to scalp this earnings type of reports in this current market environment. So bottom line, what did we do? We sent the alert to our subscribers before the market opened right here. We sent the alert to buy 85 and 83 strike puts on FSLR. Why did we do that? Because the sequence, guys, it's the market move sequence. It's the 13 markets move sequence. It's 10-7 results in the highest outcome probability of 10-7-3, guys. That's what you trade. You trade a 3 move, which basically is a gap down followed by a further drop where the market ends, or the particular stock you trade the lowest point of the day, which is exactly the case here. So if you got in into 83 puts per our suggestion, bright and early before the market opened, okay, when the market opened, you've been able to buy this at anywhere between 50 and 70 cents. At the end of the day, they were worth what? Say what? $6? $7, guys. This is not even a 10x trade. I'm calling it a 10x trade, but in reality, depending on your fill price and depending on your exit price, this could have been as much as a 13x trade. 13x. Now, good luck fucking going out there and scalping the trade for a 1,300% return. How many trades would you need to take to do this? And yet, what drives the scalping strategy is the fact that, oh my God, I don't know what's going to happen next. Oh, I'm in the green, $500. Well, let me take this shit. Oh my God, I'm up 500. Let me take this shit. And oh my, I'm up $650. Let me collect the gains. You know what? If you want to collect 500, 650 gains, okay, you know what? You should go fucking do something else. You shouldn't even be in the stock market. When the market gives you an opportunity to make 20 grand, but you're collecting 650 bucks, what the fuck are you doing? Seriously. Like, if you're doing this, you're absolutely clueless. You need some help. I'll throw you a fucking jacket. I'll throw you one of these things they throw you in a live boat. But you gotta grab it. And if you want to grab this, you'd better click the link below and get a 20-minute coaching call. There's some serious shit that you're doing wrong. This is the easiest trade you could have taken, but you miss it and you get out with a mediocre profit. Guys, you shouldn't be trading. Seriously, some of you should fucking quit right now. I don't mean to be negative. I'm just saying, like, some of you that has been trading and have been locking $600 gains, but you've been losing $3,000 on some other trades, you should fucking quit right now unless you want to make some serious change in your trading. But now let's get back after this topic that highly frustrates me because honestly, guys, all of you should be doing substantially better. Understanding 13 market moves will position you to do substantially better. It's just a matter of whether you're going to study the hell out of them and try to gain an understanding of the sequences and how to trade them, or you don't. Let me focus on the main subject of this video, which is selecting your strike prices. And how would you know what strike price to select? So let's view at some charts. Let's view at some charts to help you visualize this a little bit. So here's a daily chart of FSLR. And let me just put some annotations here. So basically, you know, this level of SLR, F90, 91, I mean, that's your top. That's your resistance. So here's a double top right here. If you've taken our charts divergence, of course, you would have known this was the damn top. And this was the time to short it. But let's say that you were skeptical of it and you were really wanted to wait till the next day of the earnings report. Well, you could have gotten right here. Well, what do you mean right here? Well, right here, I mean by this def cross. How many times did I talk about a def cross in the videos, guys? You should know this by now. When the blue line crosses the orange line on the way lower, not the other way around like a lot of traders think, but when the orange line is uptrending, but the blue line crosses us to the downside, that's a highly negative move, often refers to a def cross. And a def cross situation, you can easily expect within a short amount of time, drops in the particular stock that you're trading or commodity or whatever it is, 10, 20, 30%. So this is exactly what happens here. We've got a 10% move, easy. from 85 down to 76 bucks. I mean, easy trade, guys. Anybody could have taken it, especially when you pay attention to some other indicators right here on the MACD. You got a def hook that I've been drilling into your brain like over the last 2 months, explaining you what a def hook is. It's a precedent condition for a highly potential move lower in a particular underlying that you are trading. So now that we've gotten out of the way, the question is still, the purpose of this video is to help you select the strike prices. So based off this chart, what do you think is the best strike price? Well, the best strike price, clearly you're thinking, well, we know the stock is going to drop at least to $77, $78. Well, wrong. You don't want to select a strike price that coincides with where you think the stock is going. So basically a 77, 78 strike price would have been a disaster on this trade because it would have not made you nowhere near what you should have been making on other strike prices, such as the 83 strikes that were suggested to our traders in the group. So basically, the main purpose of understanding this is before you go and select a strike price, you should highly focus on the chart, on multiple time frame charts. And observing some of these different time frame charts would have communicated to you that, look, there's a strong support level at this level right here. So how do you apply that to selecting a strike price? Well, it's simple, okay? The stock opens at 85, roughly just under. You expect it to move 3 formation based off the sequence 10-7-3. What you want to do is you want to stay short through the remainder of the day. If you don't understand what the hell I just said, please click the link below and talk to a senior trader here at 13 Market Moves. But trying to explain this in as little of time as I have in this video, basically it means move 3, that there's going to be a follow through on the downside throughout the day, and something that you're trading has the capacity to finish at the lows of the day. That's the utmost probability for the day. What you want to do is you want to initiate the position, but you want to understand the size of the move. And the size of the move and understanding the size of the move is what's going to communicate to you which strike price you should select. So in this case, if you think the stock is going to move to $78 or $77, your strike price should be above that level. So in other words, if you think something is going to drop to 77 or 78, you should not be buying a 78 or 77 strike price, because ultimately the calculation is simple. By the time your options expire, you want to be in the money. So if your target is 78 or 77 and the stock indeed does drop there, you don't make nothing. So in other words, you were correct on the direction of the move, but you were not correct on the magnitude of the move, and that is actually what loses you money in trading options. So basically, if you think something is going to drop based off your calculations to a level of 78, you want to get a strike price above that, like 79 or 80 or 81 or 82 or 83, 84, 85. Anything above 78 will make you some kind of money. But then it goes further. Depending on what strike you pick in relation to the size of the move, some of these strikes are going to generate more money. In this particular case, it was the 83 strike that generated you 10x plus. So it's not the 85 strike. 85 strike got you 6x, no problem. But it was the 83 strike that got you 10x. Understanding the way these options are priced in relation to the size of the move is what gets you paid. So one thing you should have learned by now, you understand that the stock has a great potential based off a move 3 to drop to a level of 77 or 78. You don't want to pick a strike price below that. So in other words, if you're like, oh my God, this shit is going to fall out and it's going to drop, you shouldn't be going for the 70 strike. You shouldn't be going for the 72 strike, because the high probability the stock is going to pause right here. It doesn't mean it cannot drop further, but since we're trading weekly options, it's important for you to understand what the stock is going to do now, today, tomorrow, okay? And sometimes you can really nail that based off some of the characteristics we share with you in the charts and divergence course. So basically, here's your def cross. Here's the double top right here, guys. All of that stuff is easy. In order to select the right strike price, you need to understand, based off historical patterns of a particular stock, what is the size of the move. And in case of FSLR, it can easily make a move of $6 to $8 around earnings, which represents nicely about, 6 to 10% move. So based off that, what you target is a move from 85, possibly to 76, but more likely to 78 based off the historic movements in FSLR stock around earnings. And if you're not sure how to calculate this historic moves, guys, again, we have a charts divergence course. You should study the hell out of it so you can understand this better. But you have an idea roughly of what a stock can move. And for every stock, it's going to be different. Don't expect the stock of Bank of America to move in the same fashion the stock of FSLR is going to move. So Bank of America is going to move maybe 50 cents a dollar, while this stock is moving, $6, $7, $8, $10 in instances. So not every stock is the same, and you should compare the history of that particular stock to its prior history around earnings, opposed to comparing it to other stocks. That's how you nail some of these trades. So understanding the size of the moves allows you to figure out how low can this thing drop after the earnings report. The type of the move that we're trading right here in this particular case, it's a move 3, allows you to stick with the position through the end of the day, understanding that there is a high probability the stock is actually going to hit the lows of the day by the actual end of the trading session. And understanding the size of the historical move allows you to select the correct strike price, which in this case is going to be any strike above this 78 level would have made you money. So this is the easiest trade, guys, out of all the trades that we have taken on Friday. And honestly, guys, if you have not made at least a 10 or even 8x on this type of trade, you've got to reevaluate what you're doing. So maybe you're trying to study the course. Maybe you don't know nothing about the course. Maybe you're trying to follow some of the ideas and charts that we present here on this channel. But if you're not nailing trades like this, you should definitely reevaluate what you're currently doing. Or you should just fucking quit trading, because it makes no sense if you're catching this couple of $100 here, couple of $100 there, you lose it, couple of $100, couple of hundred. You're not going anywhere. So why are you doing this? At some point, you got to start asking yourself a question. Why the fuck am I doing this? Okay? And if your answer is like, I understand, some things, but I'm not catching these 10x trades. Like these 83 strike puts were 60 cents and you guys were selling them for fucking $6. I'm not able to catch trades like that. Then the answer is, you've got to improve. Before you take your next trade, you should do something differently. You should try to get some help. You should try to get some extra information. You should try to get some extra knowledge so next week you can do better. Because the opportunity to make 10x was here. Our students have done it. The question is, if you know some things and you saw this trade, why didn't you do it? But Leonardo, you didn't talk about FSLR in your last video, man. I know, but I did talk about Amazon, which takes me to the next trade. So why aren't you making more money on Friday? I mean, we broke down this trade to you. We told you to short the hell out of Amazon, but the bottom line is, why didn't you make more money? Let's analyze this trade, guys. So Amazon goes into earnings at this level of 34.60, roughly 34.70. It pops. As we described, the type of behavior, the type of pattern, it's kind of like a 90% probability these days. Doesn't matter, right? If it's FSLR that deals with alternative energy, if it's Amazon, which is a technology/retail stock, it doesn't matter. It's the pattern that matters. So it pops and it drops. Well, by the time it opens the next morning after the pop, it's already giving you a way, it's giving you a sign of what it's going to do for the rest of the day. So it's going to make the same thing. It's going to come right here. It's going to pop and it's going to drop. And it does it multiple times throughout the day. So overall, if you take a look at this pattern, it's a move 11. But overall, throughout the day, it's a move 2. Understanding these key characteristics would have allowed you to stay with Amazon puts throughout the day. Now, this is what we've done with our group of traders. We've actually been getting into Amazon right here at about 35, 37. buying the 35.20 puts. Now, it is a much more difficult level of trade because opposed to FSLR, look, you got much stronger bounces right here. So when you buy the 35.20 strike and it drops and it doesn't break this level, which basically set right at the open, you start thinking, oh my God, they're buying the damn dip. And that's where you go wrong, right? So you jump out of the trade and you maybe lock mediocre gains of $500 to maybe 2K. But you miss out on the real move. And the real move is the move that comes from 35.20 all the way down to almost 34.60. That's the move that gets you paid. Now, if you don't understand why that move gets you paid, you should really schedule a call with Senior Trader. But let me just shed some light on this. At this point in time on Friday, when this thing bounces, your put options, they lose so much premium that you actually get a bargain on those puts. So if you're getting in on the bounces, if you're shorting the bounces, this is how you can get these exponential type trades that pay you 5x, 10x plus. So this was your ideal entry because at that point nobody thinks, oh my God, there's no way Amazon's going to break 3,500 and such good news. But it does exactly the opposite. Well, we already knew this pattern based on the observation going through after hours and pre-market on Amazon. So this was a no-brainer for us. As a matter of fact, we're so certain of this trade, we actually sent the alert in the group saying our target on Amazon for Friday was 36.62. And we basically nailed it. Amazon drops to a level of 36.6187 right before the market closed. So the question is, you may be thinking, okay, this video is about strike prices, so what can you tell me about the strike price in this particular case that could help me out? Well, as I know, a lot of people listening to the video, they were like, oh my God, let me buy the 3,400 strike. Let me buy the 3,300 strike. Guys, the stock moves 200 points higher. It loses 100 of that move, 100 points of that move before the market opens. And in a move 11, you should know this. Move 11 will lose just as much throughout the trading session as it gains pre-market or after market. So in this particular case, you should pay attention, very close attention to the foundation, where the move started. Well, the move started right here at 34.60. You had a 200-point move to the upside. By the time the market opens, it's down 100 points, which means it still got roughly about 100 points to move lower. Now, that's just the basics. In order to illustrate this better to you, I'm going to pull up the longer time frame chart on Amazon, and let's take a closer look right here on Amazon and help you understand this trade a little bit better. So overall, this is a highly bullish trading pattern in any stock or any commodity or whatever that is you guys are trading out there. So you've got this situation right here, which is often referred to the most bullish pattern of any patterns out there. It's known as a cup with a handle. So the cup with a handle generally has a capacity to break out substantially higher. So here's the cup, here's the handle, and what follows normally would be a 10, 20, 30% move to the upside. Now, knowing the history of Amazon, like all these charts, they should be taken into consideration within the context of the historical behavior of the stock. And that's what most of the courses are not going to teach you guys. So if you're really trying to evolve into a bulletproof trader, a rockstar trader, guys, it's not just about the charts. As a matter of fact, it's not about the fucking charts at all. It's about the charts, divergences on the charts. And when you combine that information with the market moves, that's how you nail some of the most powerful trades you'll ever in the history of your trading will be able to put together. So, bottom line is this. Pay attention closely. This is something you can easily learn from the charts divergence course. So, Amazon goes to 3,400. Where's the RSI? Well, it's right here. It's at the highest point on this time frame. Now, notice now, Amazon goes to 35.50. Where's the RSI? It is actually lower than this point in the RSI. This is a bearish divergence. Although the price action is moving higher, The RSI is actually moving lower, warning you that the overall move that is developing, and notice I'm not talking about the move like here, oh, it's up, it's bouncing, it's up, it's bouncing. The overall move, look, from here, the overall move is lower, which is what you need to understand if you're a day trader or a swing trader. Despite of this highly bullish pattern, which is known as a cup with a handle, it's not that simply that you need to be paying attention to, otherwise everybody would be making millions trading stocks. But it's the divergences that I'm showing you right here, guys. That's what gets you paid. It's understanding not what's now, but rather what's coming next. And based off the highly bullish report from Amazon, based off this cup with a handle, clearly a lot of guys on Wall Street, they were highly fucking bullish. And they got killed. And they got killed. And they got killed again as they were trying to buy every dip throughout the day on Amazon. Now, 13 market moves won. Again, why? Because straight out, right here, we're buying 35-20 puts. We're able to accumulate them between a level of $8 to $10 per contract. And we actually managed to keep our students through the end of the day. Now, how would we know to do that, guys? Well, because it's a move 3. Because we understand the move 3. If you're trading with a coach at 13 market moves, he understands what a move is, and he understands when the hell to get out of the trade. Now, again, you could have gotten into this trade in the morning when the stock was dropping, buying puts, and guess what? You could have gotten out right here when the stock was popping, which is exactly the opposite behavior you should be doing as a day trader. You don't buy stuff when it drops. On the put side, you wait for the bounce. That's when you short it. That's when we waited. Right here was our entry. After that, as you can see, it's pretty much even shot lower, but not without the bounces. And it's the bounces, guys, that will get some of your best trades killed. And you'll jump out. You'll look at this. Oh my God, green candle, green candle, green. I need to get out. And you get out, and then you're like, oh my God. And this is where you think you need to be getting back in. It's just too damn late, guys. So the core move is what our coaches know how to determine. So if it's a move 3, you've got to know how to utilize that strategy that day. And it's not jumping out on the bounces. Bounces are your friends, not your enemies. Let me show you again who are your friends. Okay, now that we have established that bounces are your friends, not your enemies, remember, next time you have a highly exuberant pattern like that where everything seems to be positive but the stock is selling off, what you want to do is you want to short the bounces. Now, understanding this information and understanding this right here, it's the move 11 that gets you paid. Move 11, you have to understand the foundation, which the foundation of move 11 is a failed breakout. Failed breakout, as you can see, is right at this level of 34.60, 34.65, meaning that when a stock is going to attempt to break out on a positive move, it's going to reverse to its mean. And the mean right here in this particular case is this level of 34.60. We've talked about it in multiple videos, really having you visualize the potential that Amazon could have. But also we mentioned a high probability, because Amazon have not been able to break above that level, that was going to be the gravitating territory for Amazon stock price, naturally to reverse to this point and potentially to go below that. Now, the reason why you wouldn't necessarily go and buy this 3350 or this 3300 strike is understanding that this is a move 11. This is a move 11 formation, which simply does not necessarily go negative. It could go dip just slightly negative, but just a small, very small magnitude. As in the case of Amazon, as you can see, it finished just about $3.80 lower. But it's this move 11. It's this move 2 formation intraday that helps you gain an understanding of where and how big is the magnitude of the move. So understanding which direction and the magnitude of the move is absolutely the 2 things you need to understand when you're trading options right after earnings. With that said, guys, let me review this chart one more time. So basically, you wouldn't want to select, if you were certain that Amazon was going to drop to 33.60, you would not want to buy the 33.60 strike price, because as you can see, it would have expired worthless right here. So Amazon at 33.60 would have not made you any money at all. It would have not made you any money at all right here. It drops to this level that we predicted accurate, and it stops the drop. And by that point, your option would have expired worthless. So make sure whenever you're trading options, if you're expecting to move, in this case, we're expecting to move to 34.62, that you would buy a strike price way above that level. So 35.40, 35.20, 3500, all of these strikes would have produced some healthy gains. Now, if you move to the strikes like 34.80, 34.70, okay, knowing that the lowest level of stock based off your calculations could reach is maybe 34.60, those are not as lucrative. So it's not all what it seems, even though those strikes are substantially cheaper as far as the cost that you're paying for the strikes, but it doesn't mean that they are going to generate the best results, because you're looking at a particular level here. It's easy to see this level based off this context right here. And if you were to take a look at a 10-day chart, 5-day chart, and so on, you would have clearly seen that this was the level where the stock can retrace to, but not necessarily go way beyond that to the downside within a 1-day time frame. So guys, these things are important. If you want to nail the strike prices, you've got to understand the stock chart. And in this case, it was 34.62, baby. 34.62. Understanding that would have caused you to buy a strike price above that level, and you would have guaranteed a payout if you understand the move formation. So if you have not gotten at least a 5x return on Amazon after watching our last video, I can tell you with 100% certainty, you either did not short the bounce, meaning you were probably buying puts as the stock was dropping instead of shorting the bounces, or two, you got a strike price way below what the average historic range for Amazon dictates to be, which you probably got a 3,400 or a 3,300 type strike price on the put size, and clearly that would have been worthless by the end of the day. So here's the signs. Again, if you are targeting a move in the stock, first, what do you want to do? You want to take a look at the chart. Second, you want to understand what move the stock is likely to make out of the 13 market moves. Third, based on that information, you've got to select the strike price that is going to be above that level if you want to ensure that you're closing your position at a profit. Okay, guys, so now we're going to glance at a trade that was actually the most difficult trade out of all trades on Friday, and that is trading SPY puts. Or to get a closer look at this, we're actually going to analyze S&P 500 futures. And yes, you can trade options on them, guys. And those often are a lot more lucrative than trading SPY puts. And if you'd like to learn more about that, simply visit 13marketmoves.com and schedule your 20-minute coaching call. Now, if we take a look at these puts right here, generally S&P 500 and Amazon, they are highly correlated. So if Amazon is breaking down some key levels, like the moment Amazon breaks under the 3,500 level on Friday, you would expect the S&P futures to follow, because Amazon is just such a great portion of the index. And it does. But while the Amazon continues to drop, the overall index is stalling out, because some of the other heavyweight champs, they're not following Amazon. They're not necessarily dropping to the lows of the day. What they're doing is they're stalling, creating small type of bounces, and this is what creates this locomotion here. So this is a really great example of selecting a strike price that can either double your account or actually completely result in an entire loss of what you invest in a trade. So we were suggesting buying 420, 419, 418, and 417 puts on SPY for Friday expiration. Now, notice I'm actually going to break down specifically if you're trading with a limited size account, maybe just a few $1,000s, of how you could have hedged this position to make sure that there's no way you would lose the money, but at least you would have gained some momentum here. So the first tip is this, okay? The 419 puts, okay, yes, they're a little bit more expensive, so you would have a natural tendency to get into the 419 puts opposed to, let's say, 417 puts if you have a larger size account. Now, if you have a smaller size account, you would be tempted to look at the 413s and the 412s and so on, thinking, oh, okay, things are just about to unravel and unfold here, and I can just capitalize on this huge drop. Now, most of the time, the market is going to be tied to key levels and ranges, and again, it's looking at the chart that's going to help you identify those key levels where the market could stop dropping or where the market could stop moving higher. So within this context, to give you actually a little bit more context on this, we were buying S&P 500 puts at the close of the day, right before the market closed on Thursday. Well, why were we doing that? Because there was a strong probability of a gap down, which is exactly what we got. But how did we know that, guys? It's by studying the market move sequence. It was a 10-7 where the highest likely outcome was going to be a 3. So we got a 10-7-3 type sequence. 10-7-3, guys, it's a bulletproof sequence. It is in the 13 market move scores. If you studied it thoroughly, you would have been able to nail this simple trade. And so basically, understanding the 10-7-3 sequence, you would have been able to get into the trade right here at about 4,200, 4,210. And you would have gotten into the trade in the expectation of a swing trade and a gap down the following day, which is exactly what happened here. And you would have cashed out easily with about a 2-3x profit. Now, the question is, if you didn't know the sequence, if you didn't trade that, if you were just coming new on board, how would you have traded that on Friday? Well, again, what is the strategy? The strategy is simple. I've explained it multiple times. You want to short what? You want to short the bounces. So we've had our traders get in short this S&P 500 right about this level of 4181. Now, notice it was not the ultimate top, but understanding that this is not the area where you get a bunch of green candles, green, 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 let me buy calls, calls. No, you don't want to buy fucking calls here. You want to do exactly the opposite. Why? Because of the context, right? The context is such that this is a gap down, it's a move 3, and you're basically guaranteed that the market is not going to move higher, it's going to move lower. What you're not absolutely guaranteed about is the size of the move lower. And so this was, for that reason, the most difficult trade, and at the end of the day, it slightly bounced. And depending on the strike, you would have still made 2x or you would have lost money. So this was the challenging trade because it ended up being stuck in a range. And despite of this level of 41.68 that could have easily been broken based on what the heavyweight champs were doing that day, like Amazon just continuously got sold off and sold off and sold off, S&P should have followed, but in this particular instance, they've held it up, which indicates there's going to be a 30-40 point move lower on Monday. Based on these components right here of this chart, it communicates to us there's going to be a 30 to 40 point move lower on Monday in the S&P 500 futures. But it could have easily happened Friday. So how do you protect yourself in the event that a type 3 move does not develop thoroughly with a great magnitude? Well, the strategy number one is to simply buy Friday puts and also buy Monday puts. So let's say you're working with a smaller size account, then you would want to maybe invest $1,000 into SPY puts that expire on Friday and $1,000 into SPY puts that expire on Monday. And therefore, there's no way you can actually incur a loss. You would end up at least breaking even. But the great upside of the trade is you could make a lot of money on the Friday puts, and you could make quite a bit of money, not as much as on Friday puts, but you can still make quite a bit of money on the Monday puts if the move does materialize on Friday. So in this case, it didn't. So it all boiled down to the strike. So the 419 strike would have gotten you paid about 2x, The 480 strike would have broken even, depending on what time you're trying to exit the trade, to a potentially 50-70% loss. And the 470 strike, yes, it was highly positive. It was making you 2x when the market was dropping here and here and here. But by the end of the day, if you waited at the very last moment, it caused a huge loss. Basically, you would have been down about 90%. So here's a breakdown of a trade where directionally you know things are moving lower, but what you're not sure about is whether a key level, such as in this case of 41.68, ultimately would have been broken or not. And in some instances, getting a 417 strike is highly lucrative, because if the market was going to break this level of 41.68, we could have gotten an easy 30-40 point sell-off in the S&P 500 on Friday, which would have made this 417 puts on S&P pay you as much as 10x, 15x, 20x, depending on what your cost basis was on the entry of this trade. So, huge opportunity that did not result in a huge payout, but in similar circumstances, huge Amazon potential did play out exactly because the magnitude of the move based off the move 11 just played out perfectly. So, understanding this, what can you have done? Again, you could have switched your expiration not just between Friday, but you could have switched between Friday and Monday. And also what you could have done is, instead of just buying the 417 strike puts, you could have also bought, 419 puts, maybe put $1,000 in here. And if you put $1,000 in the 417s, there's no way you will have lost money. So understanding the move is number one. Okay, understanding the direction is number one. Understanding the magnitude of the move is highly crucial. But sometimes things are not going to work out perfectly, as nothing works perfectly with the stock market. However, the 13 markets move formula will always put you in a situation where you can profit from the trade. It's just a matter of when are you ready to take action and get out of the trade. And sometimes it really makes sense to stay with the trade, because by jumping out earlier, in a lot of instances, you can cost yourself these 10x, 20x type trades. And so if this is an aspect that you're struggling with, okay, understand that not every trade is going to be a 10x or 20x. Not every trade is going to be a 5x. But if you jump out at the point where you're making 10% or 20%, you're not even doubling the trade that you're getting into, there is no way in the world that you will make a 5x or 10x or a 20x trade, because your trading is mainly driven by fear. Fear will never make you money. So if you're trying to learn how to trade fearlessly, make sure you click the link below, schedule a 20-minute coaching call, understand in detail how to trade the move, how to short the bounces. Guys, next week is going to be absolutely awesome. I don't want you to miss out on it, so make sure you talk to a senior trader here at 13 Market Moves this weekend, because that's when our senior traders are mostly available, because they trade the markets every single day. They're heavily vested in the markets. They trade every day, every other day, depending on the market conditions and circumstances, guys. These guys are traders. So when you get on the phone, you will be talking to somebody that charting the moves every day, that understands what's going on. So make sure you don't waste any more time. You don't miss out any more of these 5x, 10x, 20x trade. We can simply tweak some of your trading just a little bit so you can take your trading skills to the next level. It's time to take action. 2021. Make it count. Don't waste another 3-4 years before you click on this button and contact us at 2025. But 2025, you can be multi-million-dollar trader, writing your own ticket, making your own shots. So make it happen by clicking the link below right now. 13 Market Moves. Let's roll. Get ready for trading the earnings next week. I'll catch you guys in the next video soon.